Hi, I'm Terrell Turner, the host of the Business Talk Library, and today we have another great guest on. Now, one of the things that a lot of businesses tend to look at is once you get to a certain level of steady cash flow and steady profit, is you're probably wondering what are some other alternative investments or places where I can invest my money to see my wealth continue to grow. So today I am excited to have on a guest, Stewart Heath. So stay tuned as we'll talk about some great options and ideas that people are looking at when it comes to situations like that. So stay tuned for today's episode. So without further ado, let me welcome on Stewart. How are you today?
I'm doing great. Thank you so much for having me on.
Absolutely, absolutely. Now, Stuart, I'm very excited to talk about Harvard Grace Capital. But before we jump into the details of that and the exciting opportunities and things there, can you tell us a little bit about your background?
Sure. I am a CPA and have been for most of my career, as I see you are as well. So I am perhaps the most untraditional CPA that you can imagine. I am a risk taker. I like to take risks. I like to build ventures and build businesses. That's what gets me up in the morning. But at my heart of hearts, I'm a numbers guy. I build systems, which most CPAs would be proud of, and so that's what I've done throughout my career.
Awesome, awesome. Now, when it comes down to, the risk taker and the entrepreneurial side, I would agree with you that we don't tend to find many CPAs that are interested in that. And it's been even more interesting for myself of when I left my full-time corporate job and as I started talking to other CPAs who were starting their own practice, in many cases they kind of approach it the same way that they did their full-time job.
Yep.
So what was
Yep.
it for you that really kind of got you out of that mode and really, sparked the entrepreneurial spirit?
Well, honestly, it was something I didn't really know about myself until I was probably 4 or 5 years into my career. So I left college and went straight to work for Price Waterhouse. I was very proud. Back then we called them the Big Eight, and that was a coveted position to get in Nashville at one of the larger firms in the country. And so proud, and I very quickly got disinterested in the audit side, which is the primary breadwinning product or service of most CPA firms. And then I wanted to get in the tax side because I felt like that was more real world. And then after a few years of that, I'm like, I can do this for myself. And so at the grand age of 25, I started my own firm. But you're exactly right. I approached it very much like my job. I'm over there counting. Okay, I've got these number of clients, and they can pay what I need to live on, and which is the complete wrong way to think about building a business. And it wasn't for 3 or 4 more years that so now I have nobody else to blame. I'm in my own firm, building it the way that I thought I should, and long story short, I hate my job. And I'm looking at all my clients, and I'm like, I really respect this client. I really respect this one. I was already partnering with some people who were building other companies and thinking, all right, well, this will add some excitement to the daily job. But so I really didn't. I finally realized that I really want to go be an entrepreneur and go do startups and businesses, and along the way really fell in love with real estate. At Harvard Grace Capital, we do private equity real estate, but Harvard Grace Corporation, which I've had for several years, we are fractional CFOs for all kinds of businesses. So that gets me, allows me to wear my CPA hat, as well as help people build their businesses, which is really exciting.
Gotcha, gotcha. And that's very interesting. The point that you make is, I found that a lot where a CPA will leave their full time job, they'll start a firm, and then now they'll dislike the new job that they built themselves, and because they own the firm, it's not like they can just leave it like they did their last job.
That's
To
right.
where,
That's
I think for yourself, as you started to really, were there any like critical things that you noticed about the way that you approach building your firm the first time, that you were like, man, I probably shouldn't have done that?
Oh yeah, yeah. To me, it's all about uh, do you want to own your own job, or do you want to work? I don't know who said it. It's better to work on your business than in your business. It became impossible for me to scale because as my practice was growing, and I was good at getting work. I was a good marketer. I landed a lot of customer jobs, uh, but uh, but I was spending all that money, and I didn't build a business by hiring the people that could go do the work so that I could spend time doing what I actually enjoyed, which was working with clients and selling. But by the time I figured all that out, I was overworked. I couldn't do what I enjoyed and do all the client deliverables too, and basically expand the pool. So all I did was own my own job, and I didn't build a business. And I can't stress that enough. So eventually I left my own public accounting firm, went into industry for several years, came back and formed Harvard Grace, and I've done it very differently this time, so that I have a team that's helping to deliver the accounting and CFO services, and I get to do the piece that I want, which is strategy and talking with clients, and of course I'm supervising the other work. But you hire good people, and that piece is rather easy. So,
Mhm.
so yeah, if and there's a whole book about this called The E Myth. Just because you are a excellent plumber doesn't mean that you can run a company that's a plumbing company. But if you're an excellent business person, you can run a plumbing company, and you might might know might not know the first thing about plumbing other than, well, it all runs downhill. And so but so many so many times people think that they can run the company that that goes with their skill set, but they can't. It's not that they can't, but they need to go educate themselves to do that.
Gotcha. Gotcha. No, I would completely agree with that. Now, one of the things that I'm curious is, do you find that, with combining your entrepreneurial spirit with, the CFO services and the strategy, that you're able to add a perspective or a value from the numbers perspective to, other entrepreneurs, because their journey?
I do. And I think that's what's actually landed me a lot of clients, because they understand I've been down the path, and I've screwed up a lot. I mean, I say don't do that because I did that and it didn't work. I mean, so unfortunately, I'm from the school of hard knocks. I've tried most ways of not to do things, uh, and yeah, I do think it adds a lot of value. The other side of that is, I've been at this nearly 40 years. And so I've seen a few cycles come and go. And what's really been interesting in the last 6 months is, we have a whole generation of people, and they're not that young, but have never dealt with inflation, or never dealt with interest rates above 5%. And back when I was coming out of college, I was coming out when they labeled the double-digit inflation and the double-digit interest rates in the late 80s, not the late 80s, I'm sorry, the late 70s, early 80s, we had a term for that. It was the misery index. You sort of put those two things together, and I don't think we're headed back there now, but 7% inflation is a serious thing that we haven't really had to think about in 20, 25 years. It's been under control, and so but I have been through that. The fact that I've made a lot of mistakes, and the fact that I'm really old and have been through some other cycles, I think gives me a perspective to help a lot of people think about their businesses perhaps a different way.
Awesome, awesome. And I think that your clients probably are very appreciative and notice in the strategy that you develop. And one of the things that I find now, as for myself, of working with you know different clients, small to medium size, is you find some that get to a point where they have pretty consistent or pretty good profit margins and cash flow, and so they start looking at what are some other options to invest in that won't completely take me away from my business. And when I saw about the turnkey real estate investing that you guys support, can you tell us a little bit about that?
Sure. Yeah. Well, and our approach definitely comes out of some of mistakes that have been made in the past. So our approach, and it's right there on the first screen homepage of Harvard Grace Capital, is stable and increasing recurring cash flow. And I've already said I like real estate. I think it is a huge misnomer that Wall Street has been able to label real estate investing as an alternative asset class. Um, People, it's the original asset class. you know, I mean, and real estate throughout time has generated um, more wealth and more millionaires than any other asset class. Although tech investing might be catching up somewhat, that's only been around 20 years. Now, that's not to say it's always perfect. Um, if you do it wrong, or you do it at the wrong time of the cycle, you couldn't get burnt. If you do it with too much leverage, you very likely will get burnt. But at the end of the day, the problem was the leverage, not the asset. So real estate is a class that can generate recurring cash flows that should, if managed properly, increase over time, because you build your leases or your models so that they adjust to inflation. And so real estate is actually uh, a perfect inflation hedge from an investment portfolio. It may not catch up, but as opposed to a portfolio of dividend paying stocks, which that's a strategy I like as well. It's a good strategy, but your companies may or may not increase their dividend based upon some inflation factor. Dividends are a distribution of profit, and are not necessarily automatically tied to their own cost factors. Most of those companies have um, have cost systems that are impacted by inflation, whereas real estate typically is going to have a revenue structure that's automatically adjusting to inflation. So that's the one I always suggest. We do syndications, and so somebody can passively invest, get regular reports from us, quarterly distributions of cash, as well as the many tax benefits that come with investing in real estate.
Mhm. And it's interesting that you mentioned that, because as you said that about how you know, real estate has been labeled as the alternative. And I was thinking about some conversations that I've had with different financial advisors, and usually in the alternative investment categories, they usually place real estate and like precious metals. And it's like, well,
Yeah,
when you think about it, like those are two things that have probably been around longer than the other stuff.
yeah, absolutely. Yeah, precious metals is a good store of value, and I've made some money in gold over the years. Just mainly in, but gold doesn't produce any income.
Mhm. Yeah.
You can have capital gains, but yeah, they also put things like art in the alternative. Art, really? I mean, that's really not for the Main Street kind of guy. And but to put real estate in, most people own some real estate. They at least occupy some real estate, so it's an asset class that's easily understood by almost all investors, and which I think is an important thing to invest in. You should invest in what you understand.
Yeah.
Um, I don't do any crypto, and I don't understand it. I'm not against it. I'm not saying it's a bad. I'm saying I don't understand it, and um, and it's not for lack of trying. I do learn a little bit more each week or each month, but as it is right now, to me, that's the ultimate alternative investment is crypto.
Mhm. Mhm.
And I'm still, and I was just on the phone with a guy yesterday who just thinks that the whole thing's going to come crashing down. It's just, I actually moved away from that position. I think no, there's going to be a home for crypto moving forward. I'm not quite sure what that's going to be.
Gotcha.
So anyway, that's just my 2 cents.
Mhm. Gotcha. No, that makes a lot. I mean, it makes a lot of sense when you think about how, real estate has been something that, has been around for centuries. It's been an investment opportunity and action that a lot of people have taken for centuries. And it is something that people are familiar with, whether it be through ownership or occupation of a place of real estate, or even just being familiar with it. Now, one of the things that I find, as I'm talk to different business owners, and one of their concerns is like, well, do I have to have a ton of money to even get started in real estate? What's been kind of your perspective on that?
Um, well, I built my first real estate portfolio in the 2000s using a HELOC on my personal residence, which is a home equity line of credit, and I use that for down payments. Um, and so that's one form of no cash down. Um, Not necessarily recommending that, uh, but it does take some cash, as any investing requires. You can borrow from a 401k perhaps, or from a self-directed IRA, and or you can buy them outright from those. But one of the really powerful things about real estate is the leverage opportunity, because it is a real asset and banks can get it's not on wheels, so 1234 Street will always still be at that address, and so a bank can wrap it around a mortgage there, and if they have to, they can come get it. It can be insured if something should happen to a building, and which would pay down debt. But the ability to leverage it, essentially 3 to 1, call that a 25% down payment, which means you can borrow another dollar for every dollar you put down, which makes you able to buy a much larger asset than you can the same amount of your down payment in Google stock, or Amazon, or something like that. All of which are good stocks, and I think there's a place for stocks and equities in everybody's portfolio. But and when you leverage that, especially in today's time where you've got low interest rates in the threes and fours, you're locking in your cost of that capital, but you will get 100% of the gain. And so our other CPA brain will say, well, what if there's not a gain? Well, sometimes that happens. What if your stock goes down? Sometimes that happens too. Most of the time, almost all the time the real estate goes up in value, as well as your equities. But so you're getting 100% of the value on 3 times the amount that you put in it, versus
Mhm.
uh, and only having to pay that interest factor on the difference along the way.
Mhm.
And usually the income off the property will pay that mortgage. So, and that
Gotcha.
works at single family homes, at duplexes, at small multifamilies. I mean, that works at every stage of real estate investing.
Mhm. Gotcha. Now, one of the things that I'm curious about is when it comes down to Harvard Grades Capital, what are some of the types of projects that you guys get involved with? And is that something that, when you mentioned syndications, where is that something that other business owners or other investors can take part in?
Sure. Yeah. Um, right now, Harvard Grace Capital is focused almost exclusively on what's generally known as the Tennessee Valley. So I'm located just south of Nashville, Tennessee, and I call it the 840 565 corridors. 840 is an interstate that runs on the south side of Nashville, and if you go south from there into northern Alabama to Interstate 565 that goes through Huntsville, Alabama, that's sort of our target area. So we're outside of a primary market like Nashville, but that takes into account uh, some secondary markets and even a tertiary market of Huntsville, Alabama, which has been booming since 2008. Uh, and and so we've taken down our first syndicated property last January, which is an office building in Spring Hill, Tennessee. And right now we're trying to get LOIs on 2 different medical office buildings in Huntsville, Alabama, both of which are 90% or better occupied. They're cash flowing, and we really like the cap rates in office, specialty office versus multifamily. We love multifamily. I think that everybody in the world is chasing multifamily right now, and I understand it's quite in demand. But COVID did a number on, quote, the office sector. But as with most everything else, there are many subsectors of office as well as retail. And the first rule is all real estate is local. I mean, the building we bought, and I'm sitting in that building now, is 100% occupied and had been for over a year. And will stay. We don't have any lease renewals coming up until 2024. Um, so, we like that asset. We really like these medical office buildings that we're chasing right now. And so there's some stability. And if the cap rates on multifamilies get a little higher, like into the fives and sixes, we'll be chasing those too. But I can't make sense
Mhm.
of a project at a 4% cap rate or lower in some cases when I'm paying 4% for the money that I'm borrowing. So
Mhm.
that's that math doesn't work for me in my head.
Mhm.
So I think they're too richly priced at the current
Gotcha.
time. So
Gotcha.
a Harvard Grace capital project will cash flow from day one. So
Awesome. Awesome. So if people are interested and they're like, okay, all right, I got to find out about, what's the latest projects. I want to keep up with Harvard Grace Capital. Where can they find you guys online?
well, the best place to go is harvardgracecapital.com. You can join our mailing list there, or you can even find my contact information and with my Calendly link. And I invite everybody to reach out, grab some time with me. I can talk real estate all the time and investing. And we have some pretty good blogs that we put out several times a week. You can find us on LinkedIn as well as on Facebook. I would direct you to our site there where you can find my contact information and the ones of my board members. So they'd like to hear from you too.
Awesome. Awesome. Well, before we wrap up, one question that I love asking every guest that comes on the show is when you think about, your history, your journey of where you've been and where you are now, it's, what's 2 lessons that you've learned that you would share with the audience? And it could be two things you've already said that you want to reiterate, or two new completely things.
Yeah, I don't think I've touched on this, but I've been doing real estate since 2000. Really struggled in 2008 and 2009, primarily because of the way I aggressively bought several pieces of real estate. I was going for maximum leverage, as I've already talked about, and ended up giving some of it back to the banks through all that, the great financial crisis. It wasn't a fun time. Learned an awful lot. And I would say something I probably should have known more about as a CPA, but I've learned firsthand the value of just having reserves, having cash on the sidelines that is not aggressively deployed. Perhaps you can keep it in some sort of a money market, to generate some return. It doesn't have to sit in cash. But as I did a post-mortem on my own experience, so I'd had about a $10 million net worth in about the midway through 2008, and as fast as things happened, about 90 days later, I probably was upside down $5 million. But looking back, if I had had as much as $300,000, maybe $500,000 in cash, I could have been in the position to actually work with the banks, keep my mortgages current, get the properties filled again, because tenants left like crazy during that time. There was a lot of layoffs, and still kept some of those assets, a year or year and a half later, and survived it. But I didn't. I didn't value reserves, and I didn't. I wasn't prepared for the downside. So value reserves, and otherwise, in other ways, preparing for the downside would be the lessons that I have learned, the hard way. But none of that ever deterred me from real estate. It wasn't the real estate's fault. So, yeah.
Well, I think that is amazing, amazing advice and amazing wisdom shared. So, Stewart, thank you so much for being an amazing guest on the show.
Thank you so much for having me. It's quite an honor. Thank you, Terrell.
Thank you for tuning in to the Business Talk Library. If you like our content, be sure to follow us on social media. And if you want to see more of our exclusive content, you can subscribe and become a member on patreon.com/Business Talk Library. Hey, the Business Talk Library is the place where business makes sense.